In this video, we're going to look at stock valuation by combining a couple of different ideas. We're going to combine the concept of a supernormal growth stock, a stock multiplier model, and of course, we're going to utilize the underlying principle of the dividend growth model. So let's think about a company. We're looking to estimate what the stock's value will be in 2015. That's the time that we're looking for. So we need some data, obviously. So let's think about what information we need. We need to know the historical earnings per share of the company. So we'll go from 2010 to 2014. We need to know those 5 years of earnings per share. We also need to know what the dividends were, or the dividends per share were for that time frame. From that, we're going to calculate the dividend payout ratio. We then, once you import that data into those columns, you have the average dividend payout ratio is 33.7, and the historical earnings per share growth is 4.437. Now here's where we have to use a little bit of understanding of the company. Is it in good shape or is it in bad shape? Do you think that the company would be willing to or able to increase the dividends that it pays out? So you need to decide whether this 33.73% is a decent average, it will be sustained, or maybe should we reduce it a little bit depending on the company. That data, 33.73, is placed right here in the estimated dividend payout. I just rounded it to 34%. In addition, this is going to calculate for us the historical earnings per share growth rate. How has earnings grown or changed in this time frame? So in this time frame, obviously it says 4.437. I input that up here because I think the company will sustain that kind of earnings growth over the next 4 or 5 years. So we need to know the current earnings per share that we got. Again, 2014 is 3.45. We need to understand something about what is the required rate of return for this company. Well, we can calculate that using the security market line hypothesis and theory from the capital asset pricing model. So we put in the current risk-free rate. I'm utilizing the 30-year treasury bond rate is roughly 3.29. This company has a beta of 1.25. And I'm using an average stock market return of 11.5%. So we only really need one other piece of data to make this work. We need to find the PE ratio of the company. Now this could be the current PE ratio, or it could be the forward PE ratio. The forward PE ratio gives us 1 year forward. We might want, obviously, since we're going out 5 years, we may want to extend that a little bit further. But again, utilizing a PE ratio that symbolizes shareholders' thoughts and optimism about the company is the number that we need to input there. So there is obviously some variability here. There's some places where we may want to play with some different numbers, use some ranges of numbers to see, what range the stock value could actually be. So once we've input all the data, we have all this data in here, we get two numbers. The first set of information, or the first step of this calculation, forecasts the earnings per share for the next 5 years. We have calculated the estimated dividend payout ratio. So now we know, we've estimated dividends for the next 5 years. We need to calculate the present value of those dividends. This is where it kind of equates with the supernormal growth stock model. So the present value of the future dividends is $6.69. The other calculation, using the multiplier model, forecasts a future price. In this case, it says the price using this estimated earnings per share out here at in year 5 of 4.286, says that the price in 5 years in 2019 will be $79.30. What's the present value of that? So once we know the present value of the dividends and the present value of the future price, our estimated value of the stock in today's money is $48.70. And of course, this is going to be compared to the current market price of the company. Again, there's a lot of things at work here. There's a lot of assumptions that we make that we really want to make sure we understand how the company is going to be acting in the future. So there's a forecast involved. This isn't exactly an accurate model because of the forecasting piece. So I hope that was useful. I'll see you in the next video.